So, today's topic is the impact of current geopolitical events on global oil and gas supply. And of course, what does that mean for our sector and what does that mean for prices? So, starting off, number one, oil is the new oil. This is something that we've seen brewing since last summer, and it's here as a fact. It's exciting. We have the prices to show it. Here we're showing WTI and Brent, where they've moved since last year. We were in COVID wondering, okay, when are we going to get back to $60 a barrel? Is it there forever? Now we're at around $116 a barrel. And the question is, are we going to stay here? We absolutely are. And we believe we're going to continue to see stronger oil prices. And before we start worrying about demand destruction, from our S&D viewpoint, we can trade at $100 to $135 Brent, call that $128 to $133 WTI for the next 9 to 12 months, and have a healthy global economy that we do not have to worry about things like the big R word. We see that the economy can take it, and these are healthy levels. When we look at where we are in terms of tightness in the front of the curve, here we're looking at the forward curve in Brent, right? And as you can see, that orange dot at the top is quite high up relative to that back end, right? And this is reflecting the fact that we have a shortage of crude right now, and the market is desperate to pay up for that crude to refine it and turn it into gasoline. Sitting in the US, we are all too aware of the situation. We've had record gasoline prices here in Norway, never seen before as well. And we have seen this really steepen versus where we were if we compare 6 months ago, a year ago, when we had that super flat curve. Where basically people were bored with the oil market. They didn't think anything was going to happen. It was all about renewables, this transition. But this is where, of course, the business cycle also comes into play. And we're in a high inflationary environment. And fund managers have actually realized that if you don't have a position in energy, you've been on a huge losing side of the table. There was this thinking at the start of the year that energy had performed so well, E&P companies have performed so well last year, it cannot possibly continue. Once we hit $100 a barrel oil, we start losing that upside on the equity space, and that is not what we've seen. And if anything, we expect people to still be getting into this market because we're still in this high inflationary environment. We have governments protecting growth in terms of the economies, but they're trying to control that inflationary side. So we think we have another 9 to 12 months to run on this market. When we look at the US dollar, though, this is where the market gets really nervous and they start talking about growth in oil demand is really coming in the emerging markets. Yes, we still believe that. And when we look at where the US dollar strength is, I can understand if you looked at that alone, why you would be a bit nervous. And if I showed the last 5 years, we are at the historic all-time highs. But the difference is because of that war in Ukraine brought on by Russia, we are now in a two-tiered market. We have what is the oil price that the Western world is paying? And in that, I include Japan because Japan is stepping away from Russia. And what is the oil price that these non-Western countries are paying, such as India, China, and Turkey? Well, they are looking at minimum $35 a barrel discounts. India is trying to secure a sub $70 a barrel oil price from Russia because they're worried, what if we're at $150 a barrel, right? $35 discount starts to hit them. So where we've seen historically this collapse of of demand buying from emerging markets because of strength in the US dollar when we are in this tightening cycle on the monetary side, it's not the same this time around. In the meantime, when we look at the developed economies, we are extremely liquid. Of course, Americans and Norwegians hate high gasoline prices when we're driving our cars on our summer holidays. But the fact of the matter is we can still afford it. And this is where, when we look at product cracks, and so that means, what is the gasoline wholesale price relative to the Brent price or WTI price? We've seen historic highs that we have never seen before. And that shows that we have a lot of space for crude to run, which is fantastic news for producers. So when we look, though, at the volatility of the market, that has been really tough. And that is what has prevented oil prices from trading at a higher level in a sustainable fashion above $120 a barrel. It is because we have that volatility. And then, at $120 a barrel or $110 a barrel, you have a bigger margin call on your position. And so that top line is showing the Brent price, whereas that navy blue line, so second from the bottom, is showing that net positioning. And when you look where we are, even versus 2018, our net positioning is much lower, even though we are in a less volatile market. Some of these investors, of course, have gone away. They've gone to energy transition and things like that. But in actual fact, there is a lot of space for us to go higher on these positions. When we look on the gas oil side, this is reflecting the diesel situation, and that matters for industrial production. This is where the crack has been insane. That's that gray number. It's been very, very volatile. And the positioning is, relatively low, call it medium level versus where we are. And it doesn't reflect that squeeze. And the big question from Bloomberg this morning, are we going to see it more on the gasoline side or on the diesel side that we see the tightness? Well, with OPEC increasing production, that should allow China to refine more products now that they're coming out of lockdown and start sending that around globally. But it's a far way to sail. The immediate need is for gasoline in the US, but then come the autumn, we need that diesel and distillate going into the fourth quarter. So we should avoid having this kind of supersonic oil price that kills off demand in the fourth quarter because we're short diesel. That is what we're hoping for. That is what the Biden administration is hoping for, because at $115 to $135 a barrel, we're all super happy in the industry. When we look at the stock levels, just focusing especially on the bottom two charts here, you can see that we are off the charts, well, on everything. We're out of the range in terms of what we've seen historically in the last 5 years on stock levels. And the problem is that even with OPEC agreeing to increase production these next 2 months by more, by 648,000 barrels per day instead of 430,000 barrels per day, we're still going to draw. So these stocks are going to get lower while we see demand continuing to rise. But let's forget about the geopolitical question and let's look at how do we get here in the first place. So at the start of this year, we had alarmingly low commercial OECD stocks, right? And what I say about this alarmingly low, this navy blue line is reflecting inventory levels at the start of the year, right? And there have been only 2 other occasions when we have been as low as we were at the start of this year, and they were 2008 and 2014. I think those are years that everyone in the room will remember because they were the ultra boom, unfortunately followed by a bust. Why are we not predicting that bust this year? It is because of these bars on this chart. And this is reflecting global spare production capacity, namely led by OPEC. And what we can see is at the start of this year, we were at healthy levels in terms of that spare capacity of production. But because OPEC Plus has had all these cuts, every single month they're increasing production, and that is cutting away at that spare capacity. But this is the number one thing to make us bullish on the oil price. We're going to enter next year with an even tighter situation than here and a much lower global spare capacity number. So this is where also when you think about energy security and you think about as a portfolio manager hedging your risk, it becomes extremely important to own oil and energy stocks within your mix. When we look at what has happened, in fact, since the start of this year. So here we're looking at, this includes COVID, right? So we're starting with the 5-year average 2015 to 2019 OECD commercial stocks, and we saw that supersonic build in 2020. Disasters led to negative prices, but by the third quarter, we started drawing every single quarter. This is something that the agencies have not come to terms with. The IEA, when they talk about where we are in terms of demand, overall global oil demand hit the 2019 level already last year, September. And we know this because during COVID, we were watching every single tanker in the world trying to figure out where we're going to store all this oil. Now all this oil has disappeared and we can't find it anywhere. So clearly demand has to be higher because we know what is going on the supply side. So this is something that, when they talk about peak demand, we've not seen peak demand. We expect it to continue going forward. And this despite the fact that we've had lockdowns in China this year. So when we look at these agency balances, a bit complicated to look at, here they're just, the takeaway is they're far too bearish. And there's a lot of upside to come. So where are we actually going to find oil to replace things in this market? So last night we had the EU officially say that they're stopping Russian seaborne imports of crude within 6 months, of refined products within 8 months. So what does that mean? Russia has been exporting almost, call it around 5 million barrels per day of crude into the European Union. Does that suddenly disappear? Then you have around 200,000 barrels per day that used to go through CPC, which is in the Mediterranean, but that's mixed in with Kazakhstani and Azeri crude, right? But you can't take out the Russian crude. For right now, that is allowed to continue trading, but you have these up to 5 million barrels per day of production at risk. However, as I said at the beginning, we're going to have China and India buying this oil, and Turkey, and replacing the European buyers, which has already started happening. We've seen higher sailing, so it's bullish for the tanker market. And it's these kinds of inefficiencies that also produce opportunities of price spikes. Having said that, we're very conservative on how much of a cut down we get in Russian oil in the short term this year. We're looking at 2 million barrels per day max. Right now, we think they're down around 1 million barrels per day in terms of production. At the start of this year, they were producing 10.3 million barrels per day, to give you perspective, right? The US producing 11.3. Yeah, that just are some numbers for you to work with. The IEA, for example, thinks Russian production is going to collapse by 3 million barrels per day in the short term, and this is something we just do not see with those trade relationships. However, when we think about Russia in the medium term, that's where the exits of the Schlumbergers, of the McKinseys, of the BPs, that's where the impact really comes in. And this is why we've seen the big oil traders like Vitol and Trafigura said they're not dealing with Russian crude anymore come the start of the new year. And Vitol actually owns a stake in Urals productions. They don't even have to pay for it. They can just take it and not deal with the whole payment side of things. But why are they stepping away? It's because they've realized that the Russian market is just not interesting, potentially a dead market for many years to come. So they're looking onto newer other pastures on the oil side. Now, then when we look on the OPEC side, we started off the year at quite a lot of spare capacity, over 4 million barrels per day. That dwindles down to 1.9 million barrels per day. In a best case scenario, that Iraq can actually load oil at a rate that they've never successfully done in terms of a ramp up, right? So this is when OPEC said we're going to raise production 650,000 barrels per day over the 430. We see an extra 250,000 barrels per day coming. That's it. When we look at non-OPEC supply, where is the oil coming from? It's coming from predominantly US shale. I come from Rystad Energy prior to Pareto, and they were always huge bulls on the shale side, especially because shale reacts to oil prices. And we've had much stronger oil prices than the majority of the market expected. However, we still see the US underproducing versus our forecast. So in December and January, 2 months in a row, production came out 200,000 barrels per day below our expectations. In February, it came in 500,000 barrels per day below expectations. And this is because it's only 1/3 of the producers that are really able to take advantage of this high price environment. And those are the private equity owned producers in the energy space. The oil majors, they are increasing production some. They're forgiven if they do more stuff in the Permian relative to other things. There have been some difficulties in international production that has, that the U.S. is helping supplement them to keep production towards their guidance, right? But that third, those exchange traded shale companies, they have to focus on satisfying their shareholders. So they need to make production numbers, but they cannot increase capex. And this is the problem. We have inflation across the world, especially in the US, and we're only starting to really see it hit the supply side and oil field services in the US. And so this is where, sand is more expensive. There are no employees to the levels that we want. And we're getting that lag in terms of the rig growth versus that production growth. So as a result, we only see 900,000 barrels per day year-on-year growth coming from the US this year versus our high case of 1.5 million barrels per day just 2 months ago. And that is a massive, massive difference that OPEC cannot make up for. In the first quarter of next year, we'll start to see supply grow, but it's not enough to fix the balances. Iran and Venezuela, these are countries that were worth forgiving, we thought, but nothing's happening. 50% at best will get a deal with Iran, but it's looking increasingly difficult and a no-go. That was supposed to be 1.3 million barrels per day of oil coming in by year end. Not happening. Maybe we'll get 500,000 barrels per day next year. Venezuela, an easier case, some can argue. We think that within 12 months, they can add 800,000 barrels per day of production, but that hasn't started. In the immediate term, through Chevron, maybe 200,000 barrels per day, but we're not even started on this part. So when we look at things, what does that show in our balances? And this is where you see 20, kind of that middle section, we see draws, first 3 quarters of this year. This is despite SPR releases by the US government. OPEC increased production, and we just don't build stocks this year. We start to build them end of next year. Why is that? That's US supply growth. And that is where we see a slowdown in demand because of all the tightening that we're going to have globally on interest rates. This assumes a soft landing, not a hard landing, but we're still landing. So that's something very important to keep in mind. So when we look at our price outlook, we see our base case is $112 per barrel for this year, but actually we are going to raise that because we see that the market can handle $100 to $135 a barrel without a change to demand destruction, without any demand destruction, and we see China coming back. When we look at next year, overall, the average looks stronger than this year because we're coming from an even lower stock situation. When we look towards 2024, why does it come down to $90 a barrel? It is because we do see really material growth from the US, while Russian supply hasn't really collapsed yet the way the medium term can suggest. And this is something that can change, right? And this is where, when we look at the long term, we stick to $70 a barrel. We will overshoot that for periods. We will undershoot that. But the crucial thing to realize here is that, for example, in the North Sea, we haven't heard of any project being sanctioned in the last 3 years at above $35 a break-even price, right? Historically, we do S&D. What can you produce at $35 a barrel? Where is demand at that? There's such a disconnect, and this is what drags it up, to $70 in the medium term. But really, there will be periods when we are absolutely at above $100 a barrel. When we look at Emp Valuations, it's a complicated chart. What it's basically showing is that within 2 years, you're getting more than 50% back in terms of free cash flow. These companies are so in the money. They're paying dividends. They don't know almost what to do with this money. And this even includes Equinor, which is spending $26 billion on renewables. Now, it's 1/3 of their capex. So this is where we are in a fantastic environment, but it's lagging the reality. So gas and power. So gas prices in Europe in particular are reacting to storage and flows from Russia. And this is where we've had such extreme volatility. We hit in March a figure that would have suggested that Russia had completely shut off supply through Ukraine and Poland. It didn't actually happen. That was kind of the market high, right? What we have is that Russia is exporting less gas, but they continue to export it. Now, when you look at this orange line, that is the UK price. And it has really moved away from the Dutch price. And why is that? It is because we have seen that LNG imports have really jumped, and the UK has this LNG terminal capacity. So does Belgium, so do other places within Europe, but it's not at the levels that we actually need to displace Russian gas in the short term. And when we think about how we got into this situation, and going back to my studies from 96 to 2000, that is when Ukraine gave up its nuclear weapons to Russia for that security guarantee from the UK, from the US, and from Russia that it will always have its territorial integrity, plus some money to help on the investment side. We can see that inventories were dropping off that black line. They fell out of the 5-year range, 2015 to 2019, pre-COVID, over the course of that time, right? And this is really Putin also gearing up to create this opportunity that he hasn't had in 20 plus years. In 2001, he announced in his New Year's address as a new president that he was going to bring back the Soviet Union. And he is a patient man, and he has waited until we are in this situation. So what the EU is trying to do is mandate that all of these countries have to have 80 to 90% of their storage filled ahead of the winter. This is a very tough thing to do, even when we have gas flowing normally out of Russia, especially because Gazprom owns some of this storage, right? It's not owned actually by independent companies, European companies, or by the European government. So this is where we need a complete rethink on how we work with natural gas. This is a lot of the meetings between the US and Europe is about solving this problem and how we're going to get more LNG in. As you can see here, LNG imports are trending higher. Frankly, they should have tried to be at that peak number from the first day of the invasions. But of course, we are spot buyers of LNG in Europe. We don't have the term contracts that Japan and China has, for example, right? And as a result, we kind of had to wait for them to not want to take everything. And this is where the COVID situation, the zero COVID policy in China has really created an easier environment for Europe to actually pull in natural gas through LNG without having completely skyrocketing prices. But now we have those lockdowns ending. If we go back to where we were in Shanghai, we talk a lot about demand destruction in China from oil, but we could see 15% less natural gas demand in that severe situation, which would alleviate the crisis here in Europe, kind of get us through for next year, and then start rebuilding that new trade route and that new world situation. But as you can see here in this bottom line, Russian gas exports have been way lower than even last year. And last year was already a low year from, the fourth quarter in particular. So we are behind in terms of what we're getting from Russia. Now, the most effective way to hit Russia is actually to sanction gas. Why is that? It's because 80% of Russian gas that is exported is piped through to Europe, right? That cannot suddenly be replaced by LNG terminals in Russia sailing to China or new pipelines being built to China, right? That's going to take 5 years, 10 years at best. And already Xi and Putin in the fourth quarter of last year had a meeting saying, oh yeah, if Nord Stream 2 isn't coming, we're going to have a new pipeline to China. Well, guess what? You better build that, because Nord Stream 2 is never coming online. And Germany is trying as quickly as possible to wean itself off of that natural gas. Now, if we were to sanction Russian gas, what does that mean, right? For the whole of Europe, we would come up around 13 to 15% short of our necessary 55 BCM that we need in terms of supply. But the hit actually isn't to Western Europe. Western Europe is only 3% down. And so when everyone says it's all about Germany, it's actually not all about Germany. It's actually all about Eastern and Central Europe, right? And that's where we have the two factions. We have Poland that is pushing for this in the hardest way, even though Poland and Ukraine themselves would be down 54%, right? If this were to happen. But they are concerned about surviving with this bully next door in Russia. They will get through the winter somehow, but they need to make sure that they are not obliterated. When we look at, of course, Western Europe can then send some flows over to Central and Eastern Europe, which is what they have done when Russia has sporadically shut off gas exports to Poland. And there is that expectation. When we look in Southern Europe, you still have import capacity to, for example, Italy, but they still do come out around 8% short. So that is how everyone in Europe really has to band together to try to get through this. What does that mean? Power prices will be high here. And that will, of course, facilitate more energy transition. But this is where we have to go through the business cycle as well. We're late cycle. That means that some of these unproven or less proven energy technologies and companies that have gotten a lot of money during COVID, their time in our view is still yet to come. So what does this mean about the medium term? We think that oil demand can peak from 2028 to 2030. However, this entire situation with Russia in terms of the war in Ukraine, at the same time when we've had super liquid markets with tightening, it can actually together delay that peak demand by a few years. When we look at what oil prices have to do to stimulate investment, they actually need to be quite high, because this is where we could see 10% year-on-year decline rates in Russia coming in as soon as 5 years. That's 1 million barrels per day less oil. That's half of Norway's production every year that needs to be replaced, just because of this dire situation in Russia. So we need that high oil price to stimulate investment elsewhere, because Russia's historically had one of the lowest costs of production. So we need to look at other markets. Yet when the market thinks about spending, they're so pessimistic. Rystad Energy thinks that we need to have, oil prices at $110 a barrel almost to 2030 for us to get to the previous peak on spending. And this is just not correct. We have this inflation that spending absolutely has to happen. Saudi Arabia has no spare capacity. They put out a tender last summer in August for 110 rigs. They secured 11 by the start of the first quarter this year. And this is something they need to spend, a year building out. Finally, last slide, Ukraine-Russia peace. We don't think that is coming. We think that NATO has realized that the only way to have lasting security is to actually handle this Russia problem for real, put them to the side quietly. And that does not mean negotiating a bad deal that then allows Russia to just go back, reinforce itself, and invade Ukraine and or Poland and the Baltic countries. So thank you.